This question of moving and time frame is an interesting one, because if we're all right and the housing market is going to correct by anywhere from 10 to 50%, negative equity becomes a big issue. I had negative equity in my house. I bought and sold right at the top in 1989. So I sold my 1920s bungalow, bought it for $75,000, sold it 4 years later for $300,000, spent the $300,000 in Oakville. I then had 10 years of negative equity. Now, I didn't have to move. I had a job. I was paying the mortgage, so it wasn't a problem. But if you have to move, negative equity becomes a huge issue. Yep.
I want to deal with the rates issue right now, you know, fixed versus variable. It would seem, with rates low right now, that this is the time to go fixed. Yes? No?
Almost always, Peter, it's better to go variable. The economic data is very clear that almost all the time you're cheaper to have the shorter run mortgage that you refinance on a regular basis. This may be one of the exceptions right now. So every rule has an exception. This may be one of the very rare times where it does make sense to lock in for 5 years or whatever to take advantage of the low rates. But even that's not certain. You know, there's still a lot of storm clouds in the world economy, what's happening in Europe. Even our own performance isn't fully out of the woods yet here in Canada. So it could be that interest rates are going to stay low for longer than we think, in which case you're still better to stay with the variable.
Hard to imagine going lower, though.
They certainly will not go lower. They can only go one way, and that's up. The question is when. And even that, you know, it looks like this would be a time to lock in, but even that isn't certain.
Any disagreement at the table
Well, the
on
only
that?
thing I would say is that I'm not sure the jury's entirely out. To me, the house always wins. So the banks have structured their affairs so that fixed or variable works for them. You're going to get some kind of margin. To me, the question is, how much risk are you comfortable with? If you're comfortable with risk of seeing a different number every couple of years, then variable may well be the way to go, because you can get really, really good rates at variable right now. But if you're like me, and that makes your stomach curdle, you want to know what you're doing, you want to be able to plan for the future, then you fix. To me, it's a psychological choice.
I would add to that, and that echoing Jim's point, normally variable is statistically shown to be the better way to go. Of course, we've also seen prime minus 0.9 in terms of the discounts. Those have gone away now. So the margin between variable and fixed are totally different. But the other thing I want to point out is it is about margin of safety again. So instead of looking at 5-year variable versus fixed, take a look at 10-year fixed, because the rates are 3.99%. And if you met anyone who had a mortgage in the 80s, they're going to say, if I could lock it for 10 years at 4%, sign me up.
Right. Okay, we've only got a couple of minutes before we take a break, and I want to break this up a little bit in terms of trying to figure out where one should be at a certain age in terms of their aspirations, their dreams of home ownership. Jim, Jim and Preet, give me the idea about the 30-year-old. Where should they be in that picture?
I think it depends where they're at in their life at 30. You know, some people at 30 are settling down, they've got kids, they've got a job they expect to stay with, and in that situation, by all means, unless you're in Toronto and Vancouver, buy a house, because you're going to pay yourself as you pay down the mortgage. You might get some help from your parents to put down the down payment. That's how I got into the real estate market, and you'll be better off in the long run. If you're still one of those kind of footloose 30-year-olds who's intent on traveling and isn't sure where they're going to settle down, then you don't want to be tied down, and this is, again, where it's all about your life. What type of housing fits your life? That's the most important variable.
To be footloose and 30 again.
Yeah.
Preet, briefly, anything to add to that on the 30-year-old?
What I would say is that one of the biggest problems for 30-year-olds is that they've experienced such a lifestyle inflation. Forget about CPI inflation, lifestyle inflation in terms of what they want. They want the big houses. They want their kids to have ensuite bathrooms with bidets in them. It's nuts. So you go to Toronto, Vancouver, there's no way you can afford a house today, or at least you should not be. It comes down to margin of safety and having a large down payment. I would suggest that if you had a 20% down payment, you can comfortably go into the market. And a lot of people I know are saying, 20%, how do I save 20% down for a house with the prices that they're at? And there's your question. There's your answer. The house prices are nuts.
Let's jump a generation. The 50-year-old, where should they be, Patty?
Any particular reason you're asking me that?
No, I knew you were going to have, listen, I flipped a coin on this one.
Okay, the 50-year-olds, the good old days when you're in your 50s, you had no mortgage, and then you had the next 15 years to save for retirement. I'm not so sure that applies anymore. So hopefully there are people in that situation that the mortgage is paid down, but in your 50s, if not, of course, sock the money against that. But one thing in your 50s, I think there's a lot of temptation to buy that second home. And I read one analyst who said basically anybody who buys a second home is speculating. And I think I tend to agree with that. So right now, if we look at home sales in Phoenix and Miami, they're up, and they're up because of Canadians. So my concern is people are taking the equity out of their homes here or borrowing against that equity, buying that second home in the States. But do the math again. If you want to spend a month there, which is a nice thing to do, isn't it cheaper to rent? So that second home, again, I think that's a speculative move, and I would argue against it.
I was just looking at some numbers actually about this question of whether your house is a good place to put money to save. It doesn't really keep up with inflation. It's basically a good way to stay level with inflation over time, but you don't actually make money in a house. We think we do, but you don't. So to me, 50, you're still in peak earnings years. You can still have a sizable mortgage. By the end of your 50s, you probably want to see daylight on it.
There is something I want to see about if you're in your 50s, you're close to retirement, and a lot of people, they haven't saved for retirement, they've got a lot of equity in their homes. They're going to be pulling that out to fund retirement, which just means there's going to be more pressure on these large homes. They're going to be selling them, and who's going to be buying them?
All right.
I'd just add to that right now in Oakville, again, the prices are crazy, so I am tempted to sell and rent, just try and take out that equity. That $300,000 house I bought now is worth close to $1 million, which is ridiculous.
All right, I'm already a minute over time. Anybody else want to add anything more? Okay, we've got to take that quick break, but when we come back, tonight's big question. What's the one thing you need to know before buying a house? The Bottom Line shares their golden rule.